Hi and welcome back. This episode is fully dedicated to our inspiration and our mentor and one of the wisest and most humble people in the world, Warren Buffett. We wanted to make this episode as a way of saying thank you. Money and fame didn't change him, and we are incredibly grateful to experience Buffett in our lifetime. For that, we are very thankful. That's why we have put some extra time and effort into this episode, because Buffett deserves nothing less. Today, we're exploring the life, wisdom, story, and legendary mindset of Warren Buffett that went from a failing textile company to one of the biggest companies in the world. Enjoy this episode, a tribute to Warren Buffett, the Oracle of Omaha. Before we begin, let me briefly mention some of his achievements and highlights, because they do deserve to be said. Warren Buffett is worth over $150 billion, and different from many others, he did this solely by investing. He has outperformed the S&P 500 for 6 decades. Yes, that's 60 years. Pretty impressive. Buffett helped stabilize the economy back in 2008 when he invested billions in banks and General Electric and helped these companies get through one of the most difficult times in history, while also becoming pretty good investments for him. There are hundreds of books written on Buffett, making him one of the most influential and famous investors of all time. Some of the best books ever written on him are The Snowball, The Warren Buffett Way, The Making of an American Capitalist, The Essays of Warren Buffett, or The Interpretation of Financial Statements, just to name a few. According to some sources, Buffett has already donated over $50 billion to several charities. And last but not least, it is estimated over 700,000 investors have been to the Berkshire Hathaway meetings in person since they started doing them live. Many think of billionaires as extravagant spenders, but Buffett defied this stereotype. Despite being one of the richest people in the world, he still lives in the same house he bought for $32,000 over 50 years ago. He prefers McDonald's over gourmet meals, and he loves his famous cherry Coke. Buffett is famous for his humility, wisdom, and unique approach to life and investing, and this makes him one of the most influential figures of all time. Buffett was born in 1930 in Omaha, Nebraska. Buffett was fascinated by numbers at an age when most kids were just obsessed with cartoons. He memorized population figures, he tracked stock prices, and showed an entrepreneurial spirit very early on. At 6 years old, he bought packs of Coke from his grandfather's grocery store and sold them for a profit. By 11, he made his first stock purchase, City Service Preferred, with money he earned from delivering newspapers. Growing up during the Great Depression, he witnessed financial struggles firsthand. His father, a stockbroker, often discussed money at the dinner table, and Buffett wasn't just listening, he was learning the tricks of the trade. Buffett's journey to becoming the world's greatest investor wasn't linear. He started at the Wharton School at the University of Pennsylvania, but he wasn't impressed, so he transferred to the Columbia Business School, where he met the legendary Benjamin Graham, his mentor and the father of value investing. And Graham's philosophy was simple: find stocks trading for less than their intrinsic worth, essentially buying $1 for 50 cents. And Buffett absorbed every lesson. He mastered financial statements and tried spotting undervalued companies. This principle became the foundation of his early investment strategy. After graduating, Buffett was determined to work for Graham's firm, Graham Newham Corporation. But Graham initially turned him down. Undeterred, as we know Buffett now, Buffett offered to work for free, and eventually Graham gave him a job. There, Buffett mastered the fine details of investing. By 1956, Graham retired, and so Buffett returned to Omaha with around $174,000 in his pocket. That is around $1.9 million today. and he was ready to start his own investment firm. Enter Berkshire Hathaway, the next phase of his life. Before we discuss Berkshire, we must mention perhaps the most important figure in Buffett's life, Charlie Munger. Buffett said, and I quote, "Berkshire Hathaway could not have been built to its present status without Charlie's inspiration, wisdom, and participation." This is what Buffett said after Munger passed away at the age of 99. Buffett and Munger met through friends and shared an immediate connection. Buffett recalled, and I quote, "After a few minutes in the restaurant, I knew this guy is going to be in my life forever." I mean, so cool of him to say. Warren Buffett and Charlie Munger worked together for 45 years. And although this episode is about Buffett, I just couldn't leave Munger out. Okay, let's get back to Buffett and Berkshire. Charlie Munger learned that Buffett's cigar butt investing, what he learned from Graham, wasn't the best way, and low valuations is not all that matters. And this changed Buffett's investing career and mindset forever. Instead of looking for cheap businesses, he started looking for excellent businesses for a fair valuation. If he didn't meet Munger, who knows what would have happened. Now back to Buffett and Berkshire. And the story is well documented in the books and the annual letters to shareholders dating back all the way to 1965, and I do really recommend you read it. It's so much fun. And I've spent years reading all of the letters, bottom up from 1965 to 2023. So here's the story. Berkshire Hathaway started as a textile company, then an insurance company, before it became an investment firm. In 1962, Warren Buffett began buying stock in Berkshire Hathaway. He noticed a pattern in the price direction of the stock whenever the company closed a mill. Eventually, Buffett acknowledged that the textile business was failing and the company's financial situation was not going to improve. In 1964, Stanton, an American businessman who managed Berkshire Hathaway, made a tender offer of $11.50 per share for the company to buy back Buffett's shares. And so, Buffett agreed to the deal, knowing damn well the business is losing all momentum and financially isn't looking too great. A few weeks later, Warren Buffett received the offer in writing. But Buffett noticed that the offer changed from $11.50 to $11.38. It comes down to a few pennies, but this bothered the crap out of Buffett. He later admitted that this lower, undercutting offer made him very angry. So instead of selling at the slightly lower price, Buffett decided to buy more of the stock and take control of the textile company, and he fired Stanton. But this put Buffett in a very difficult situation where he was now the majority owner of a textile business that was failing. He later admitted that this was his worst purchase ever. And despite his effort to save the textile operations, the industry just wasn't favorable. And eventually, this would be the downfall of the company. By 1967, Buffett saw the writing on the wall. The textile business was failing and no amount of investments could save it. Buffett makes it clear in his letter to shareholders that his workers weren't the problem. The real issue was global competition. Other countries were underpaying their workers a fraction of US wages, making it impossible for Berkshire to compete. No matter how much they invested in technology or efficiency, costs kept rising while profits shrank. And every time they spent money trying to improve, so did their competitors. It was like a never-ending arms race where everyone just kept spending, but no one actually got ahead. Buffett compares it to watching a parade. If one person stands up on tiptoes to see better, soon everyone is standing, and no one has a better view. He quoted the famous Woody Allen in his letter, saying, I quote, "More than any other time in history, mankind faces a crossroad. One path leads to despair and utter hopelessness, the other to total extinction. Let us pray we have the wisdom to choose correctly." Meaning, either he kept pouring money into textile and got terrible returns, or he stopped investing altogether and let the business slowly die. Not exactly a fun or an easy choice. By 1985, Buffett finally admitted defeat. The business was burning cash and no one wanted to buy it. If he could have sold it, he would have, even at a lower price. But the reality was, no one was interested in an industry that was clearly doomed and commoditized. So he made a tough decision. He stopped putting money into textiles and started using Berkshire's cash flow to invest in different, stronger industries, especially insurance. And this move completely changed the company's future. He believed, and with he I mean Buffett, that the insurance industry was different from other businesses. He felt the insurance businesses could take advantage of the timing of cash paid out and taken in. For example, insurance policies include consumers paying in money, and the insurance company holds the money until they pay out the claim. But they can invest those funds between taking in the money and paying it out, also known as Buffett's famous insurance float. And with this float, he started investing. Let's review some of the most important businesses he bought and the important investments he made, and maybe we can draw some lessons from them. In 1972, Buffett and Charlie Munger had the chance to buy See's Candies, a well-loved West Coast chocolate brand. They paid $30 million for See's Candies, and at first it seemed like a simple candy business. See's had loyal customers, strong brand recognition, and most importantly, pricing power. At the time, Buffett was still heavily influenced by his mentor Benjamin Graham, who taught him to buy stocks at dirt cheap prices. Remember? Buying dollars for 50 cents, also known as deep value investing. But See's Candies wasn't a cheap company. Buffett wanted only to pay $25 million, not the $30 million price tag. Buffett almost walked away, but Munger convinced him that it would be a good deal. Eventually, they bought See's Candies for $25 million upfront, plus $5 million later. Over time, this investment turned into a cash machine, generating over $2 billion in profit. And Buffett later admitted that not buying See's Candies would have been a huge mistake, and this changed the way he invested forever. Instead of looking for cheap businesses, he started buying great businesses at fair prices. Remember, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. But he wasn't done. Buffett invested in the Washington Post for $10 million in 1973. Newspapers had a monopoly back then, meaning steady cash flow and pricing control. And over time that investment grew to over $1 billion before Buffett sold it. He backed strong management and saw long-term value in media. And after reading this story, the lesson I took away from this was monopolies don't last forever. They can be disrupted, like the Washington Post and newspapers. Okay, next one. Buffett first invested in Geico in 1976, after learning about it from his mentor Benjamin Graham. Why? Well, it had a brilliant low-cost model, selling insurance directly to consumers instead of using agents, and that meant lower costs and higher profits. In 1996, Buffett bought the whole company, and today, Geico is a very important part of Berkshire Hathaway. A lesson from Geico? Find businesses with durable competitive advantages, because Geico's cost structure, their main moat, made it a huge winner. Fast forward to 1988. Buffett bought $1 billion worth of the Coca-Cola company. It wasn't cheap. He learned that from See's Candy, and it had a huge moat, which he learned from Munger and Geico. And Coke wasn't just a drink, it was a brand that billions of people loved, and he recognized this. This investment now pays over $700 million in dividends alone. Not a bad investment if you ask me. The lesson here? Strong brands can last a very long time. Look for companies that have a strong brand. Alright, another one. Buffett bought Burlington Northern Santa Fe Railway in 2009 for $26 billion, calling it an all-in bet on America. Railroads might seem boring and old school, but they're essential for transporting goods, and they have a near monopoly, access to the most important routes back then, but still do today. And they're a key part of the United States infrastructure. And getting to build your own railroad company now? Well, good luck. The lesson is to look for businesses that provide critical services that never go out of style. Look for companies that sell must-haves instead of nice-to-haves. Alright, last but not least, Apple. Buffett avoided tech stocks for decades, feeling it wouldn't fit within his circle of competence. But Apple wasn't just a technology company, they're mostly a consumer brand with exceptional consumer loyalty, a very strong brand, and pricing power. It also helps to have an exceptional founder and good management, which has led Apple to be an amazing, one-of-a-kind company and investment. The lesson from Apple's investment can be: stay open to expand your circle of competence. Be eager to learn and embrace change instead of avoiding it. Who knows what would have happened if Buffett didn't buy Apple? Perhaps Berkshire wouldn't be as large and successful as they are today. Fast forward to 2008, the financial crisis. Wall Street is in chaos. Banks are collapsing. Investors are panicking like never before. But one man remained calm: Warren Buffett. With his usual long-term vision, Buffett stepped in, investing billions into companies like Goldman Sachs and Bank of America. Why? Because when everyone is running scared, he saw an opportunity. As he famously said, be fearful when others are greedy, and be greedy when others are fearful. Nowadays, every investor and their mother says this, and it's something you hear constantly, but only a handful of people actually apply this during those times. Let's fast forward to today and talk about the Buffett lifestyle. And this was a fun one for me. You'd think that someone worth over $100 billion would be living like a king, private jets, mansions, yachts, but Buffett, not even close. Instead of a fleet of luxury cars, he still drives a modest Cadillac. Instead of 5-star meals, he still eats McDonald's almost every day. And here's the funny part: his breakfast depends on the stock market. At least it did back in the day. If the market was up, he treated himself to a bacon and egg and a cheese biscuit. If it went down, he went for a cheaper meal. And let's talk about his diet for a second. I mean, Buffett eats like a kid at a birthday party. French fries, hash browns, Coca-Cola and ice cream. His daughter Susie once joked that he's probably never even had a glass of water in his life. And I hope that's a joke, but it does explain the uniqueness of Buffett. But the important thing is that Buffett doesn't measure success by how much money he has. He credits his happiness to doing what he loves to do every single day. To him, wealth isn't about fancy things. It's not about waking up. It's about waking up excited to work, invest and play bridge with his friends, enjoying time with their family and reading, like a lot. Almost all of his wealth, around 99%, will be donated to charity after his death. I mean, talk about having a heart of gold. We don't need luxury to be happy. We need purpose, passion, and doing what we love to do. And maybe a little bit of McDonald's along the way. Beautiful. I think we can all learn a thing or two from him. I can keep talking about Buffett for hours, and perhaps I will in another episode, but not this one. So what can we learn from him? And we've spent quite some time on this specific question because, let's be real, the man is a walking poet. So we had to make some decisions here and decided to only extract a few of the most valuable lessons for us specifically. Let's start with lesson number 1. Think for yourself. Never ask a barber if you need a haircut. This one is related to the need to think for yourself. Getting advice from brokers and financial advisors is okay up to a certain point, but if it gets to the point where you buy into someone else's thinking and reasoning, then you have lost it. His best friend and lifetime partner Charlie Munger said something similar, and I quote, "It's incentive cost bias. His professional reputation is all tied up with what he knows. He likes himself and he likes his own ideas. And he's expressed them to other people. Once you realize that you can't really buy your thinking, partly you can, but largely you can't, you have learned a lesson that's very useful in life. That is why incentives are so important and why we always look for them when we analyze companies." Lesson number 2. Integrity and humility. In looking for people to hire, you look for 3 qualities: integrity, intelligence, and energy. And if you don't have the first, the other 2 will kill you. Warren Buffett has built his empire on 2 things that money can't buy: integrity and humility. He places immense value on integrity and humility, both in his personal life and professional dealings. He believes that without integrity, intelligence and energy can become detrimental. For Buffett, trust is everything, whether it's choosing business partners or making investments. He only surrounds himself with honest, ethical and reliable people. No amount of talent can make up for a lack of character. Lesson number 3. Remember your ABCs. You need to fight off the ABCs of business decay: arrogance, bureaucracy, and complacency. When these corporate cancers evolve, even the strongest companies falter. Success can be a company's greatest downfall if it breeds arrogance, bureaucracy, and complacency. Whether it's growing an investment or building a career, arrogance blinds leaders to their weaknesses. Bureaucracy slows decisions with red tape, and complacency makes companies lazy. The best businesses stay humble, efficient, and always hungry to improve, never letting success make them comfortable. Lesson number 4. Patience. No matter how great the talent or efforts, some things just take time. In a world that loves instant results, Buffett reminds us that good things often require waiting. Whether it's growing an investment or building a career, patience is a key ingredient to success. Lesson number 5. Know yourself. You don't have to be an expert on every company. You only have to be able to evaluate companies within your circle of competence. Buffett suggests focusing only on what you know well. By understanding your own strengths and limits, you can make better decisions and avoid unnecessary risks. Okay, one more. Lesson number 6. No strikes against you. This one really hit home, especially what we're trying to do with Dutch investors. The stock market is a no-called strike game. You don't have to swing at everything, you can wait for your pitch. The problem when you are a money manager is that your fans keep yelling, "Swing, you bum!" It's fun to watch baseball players swing. Whether they connect and hit a home run or swing and strike out, it brings out different responses. But you can let as many balls go by without having any strikes against your name. And you can see this a lot in the financial world, like most investors following people that are always buying or selling. There is no need to invest in every stock idea that comes up. That's why we turn around so many stones. When the market goes up, everyone is hitting a home run. And it's tempting to swing along with them, even at the pitches that are in the glove. Most people confuse skills with luck and the bull market. Everybody looks like a genius when the entire market is going up. Just look around on your favorite socials. Investing is a waiting game. Take all the time in the world, and when the right pitch comes along, swing with all your might. I mean, there are so many more. Perhaps another episode is needed to just talk about all of his timeless advice and quotes. Who knows? To us, Warren Buffett isn't just a legend. He's something we look up to. We inspire to adopt his beliefs and advice, and hopefully we can just do a fraction of what he has done for millions of others. At 94, he's still sharp, still investing, and still offering us wisdom to anyone willing to listen. Will there ever be another Warren Buffett? Maybe. Probably not. But we can all take a page from his book. Whether it's valuing integrity, friendship, keeping things simple, or simply enjoying a Mickey D's with a smile. That's all for today. If you enjoyed this episode, please let us know by dropping a 5-star review, since this is the best way to support us. Until next time, stay curious, keep learning, and happy investing.